Hi, Joss. It's so nice to see you again and have you part of my podcast.
How about
Joss, Joss and I work together very closely over the last few years, and I'm a huge fan of you and your team, and of course, your tool that we'll talk a little bit about, your company, Cash Flow Story. But what I'd love to do before that is just give the viewers a bit of an overview of your background. So Joss is a co-founder of several startups. He's a CEO and a director and a mentor. And after qualifying as a chartered accountant, Joss spent the last 25 years working in the software industry. He co-founded numerous IT companies that have provided software to the banking and finance, accounting, and general business sectors with a user base of hundreds and thousands in multiple countries. So thank you for being here.
Thank you for inviting me, and really enjoyed working with you over the years.
Yeah, it's been great. I've missed you. I feel like the last few months we haven't been in touch. What I'd love to do, my podcast is called The Stuff That Growth Is Made Of. And, viewers may be wondering why I have a guest speaker who owns a software tool called Cash Flow Story. And what does that really have to do with growth? So what I'd love for you to do, Joss, is to really kind of kick off our discussion with an overview of why this topic is so important and how it does tie directly into growth.
So basically, my journey through software has ultimately been always connected back to the financial performance of the business. And basically, myself and Adam Milner, who founded Cash Flow Story, always been of the view that businesses tend to often undervalue their numbers because they don't really understand them, and that they see numbers or their financials as a limitation. But the reality is, the way we see it, is that people are in business to make money. And you can't ignore the financials because that's why you're in business. So we're not in business to make things or do things or sell things or import things or export things. Those are the things we do to make money. So what do we mean when we talk about making money? We're really talking about making profit, cash flow, which leads to improvement in value of the business, which is ultimately what we want out of our business, the ability to make money, take money out as we go and sell it for lots of money. So to do that, most businesses are trying to grow. So how do we grow and fund that growth? How do we make sure that that growth is actually making us money? So many businesses are focused on revenue and it's just sell, sell, sell. But in many cases, it's harming the business. So what we're all about is understanding and getting the team, the management team, the owners to actually learn to understand and love the numbers, because ultimately that's what they're in business for, to make money.
So there's so many things you just talked about that I have follow-up points on. So one of the things, I guess we'll go there, is you just mentioned something that people may find kind of strange, that, the revenue, the focus is on growing. How could that be bad if people are focused on top line growth?
Well, in most cases, in some cases it can be bad. In most cases, it's good, but it's not usually the best thing to do. So where it's bad is businesses, for example. So let's take the most simple example of we sell something to someone on credit and they take a long time to pay. So if all our customers are taking a long time to pay, sometimes getting more sales in theory is good because we've got profit, but we don't collect the money. So what's happening is that we're paying our people to do work. We're buying items of inventory maybe we're paying for them, but our customers are taking so long to pay us that every time we make a sale, we're actually losing cash.
Because we're funding it at the end of the day. Yeah.
If the business stopped operating and shut, then eventually they get that money in. But what's happening is they're just growing and growing and growing and focusing on the sale and not on the collection, paying their people to do the work, buying the inventory or whatever it is to make or sell, paying for it, but not being paid. So in that case, you can get a situation where the more you sell, the worse your cash is. So other businesses, generally what we find is putting up prices gets a much better outcome than selling more. Businesses often are scared to put up prices because they're worried that they might lose a little bit of sales. But often when we look at the numbers, we discover that selling more is actually, maybe they have to do 20% more sales. They can get the same value from a 2% price increase.
And it's so somewhat the initial feeling, and I remember when I was learning this several years ago, it feels counterintuitive because you would think, boy, if I reduce my costs, I can beat out the competition, I could get more market share, all of those things, instead of raising my prices. So I would think volume would actually be better for my business. But as you're saying, it may not be.
In probably, we look at thousands of businesses, I would say 95%, maybe more, price is significantly more beneficial than volume. So how much more beneficial? Sometimes 8 times, 10 times.
Wow.
So think about 8 times. A 1% price increase to get the same profit or cash benefit, the business maybe has to sell 8% more. So they're working 8% harder instead of putting prices up by 1%. Price increases, for example, tiny increases, sometimes it's just rounding or not rounding. So what we try and do is get the business to understand what drives their profit and cash. Because the presumption is selling more, managing my costs. Often we look at the business, it's all about the margin. So why focus on the area that's not going to give you the benefit when sometimes some small changes can make a huge impact?
I think your point also about the 1%, sometimes it really is rounding. So, people, we sometimes make decisions for our clients or customers saying, oh, they're not going to pay that. They may not even notice if we're talking about based on the amount that product or service sells for to begin with. But again, it could be a rounding area from their perspective. Or so it could be that 1% and they won't even blink. So instead of making decisions for our customers, which I think sometimes we do, a small increase, they won't even notice.
Exactly. And so often, if you're selling to, consumers on a website, price breakpoints, rounding, all that stuff is really important. When you're quoting jobs to businesses or you've got catalogs and things, it's not. So how many businesses we see sell things, they're all nice round amounts. You're selling to another business. Does anyone at the other business care if it's not a round amount? So often businesses are leaving money on the table because they've figured out something should sell for $800, $820, so they round it down to 800. Right. Would anybody not buy it if it was $814.60?
Right.
So there's money sitting there. And so by understanding what drives a business, it gets the business to focus on where the good bang for bucks are and what they should be doing.
So what we're really talking about here is strategy. We're really not talking about, a lot of times people think of finance as how we measure the business. Exactly. Or, that's the CFO's job or the controller's job, because I work with a lot of CEOs as part of the peer group that I host. And a lot of them didn't grow up in the finance side and they're not that comfortable with the numbers, but we're not really we're talking about numbers here, but we're really talking about it is strategy and the impact on the numbers.
Exactly. So if you take a typical board meeting or management meeting, the finance piece is always at the end. The CFO or the finance director or the bookkeeper produces the numbers. There's usually some graphs and stuff. Nobody's really interested. So what's provided is a lot of information, but not a lot of knowledge. So what our passion is to get the non-financial people to buy into understanding what drives their business. So what drives their profit, what drives their cash flow, and what drives the value of the business. So what we try and do is what we say is to try and get to everybody to love the numbers, so that we're focusing on driving improvement and focusing less on what happened, more around how to drive forward. So we're not suggesting for 1 minute that the information that the CFO and people provide is not important, but the management team generally hasn't bought into it. So it's about understanding, educating on strategy, as you correctly saying, around improvement. So every quarter, we work with businesses to do a power of one, which is looking at what drives their business, the 7 levers of cash flow and for profit, which is price, volume, cost of goods, direct costs, and overheads. Those are the 4 drivers of profit. Those 4 plus collecting faster, managing inventory, paying slower, the 7 drivers of cash flow. Get our team to understand what drives their business and get everyone to contribute towards improving. So often when we get that environment right, somebody from a different part of the business will comment and say, I've never understood why we do that. So we're getting buy-in to that strategy around improving the business.
It also, I think, helps, the leaders who are making the decisions, whether it's department heads or the CEO, again, as part of the strategy, but the decisions they're making, there is a direct cause and effect on cash flow, profit, and they may not even realize that. So by understanding just a handful of these levers and the numbers, you can do some scenario planning to say, oh, if we do this, for example, the example before, if we increase our prices 50 cents, what will that do to our business? Yeah. Or if we want to increase volume and decrease pricing, what is that going to do?
And what we're seeing at the moment in the world is inflation and supply chain as the 2 financial hits that businesses are focusing on. We've looked at so many businesses recently, margins dropped. Okay, your margin's dropping. Why? Because our costs have gone up. Okay, what are you doing about it? Silence.
Because they're not passing the costs on to their customers.
They're not passing on. So the question we always ask the business is, why did your costs go up? Right? And they look at us like, stupid question. Obviously, our suppliers put their prices up. Say, okay, so what happened? Did you stop buying from them? No. Okay. Why did they put their prices up? I suppose because their costs went up. Aha. So they've passed their price increase through to you, but you've copped it. So thank you on behalf of the world for doing your job to help stop inflation, but you're copping a drop in margin because you're not passing it on. Now, your supplier is supplying other people, your competitors. Everybody's costs have gone up. So why are you not passing them on? The reason you're not passing it on is because you're scared that price increase could impact your volume, your sales. The reality is it won't, because your competitors are probably putting their prices up for the same reason. Secondly, that's the world we live in at the moment. So you've got this price increase, you pass it on. If you understand the impact of price and volume and all those things on your business, you can look at that and say, well, if we pass it on, what's going to happen? And what's going to happen if we don't pass it on? And likewise,
go ahead.
Businesses carry more inventory because they're worried about running out of inventory. How are they going to pay for that? So if the business is borrowing, do they understand that carrying an extra $500,000 of stock, inventory is going to have to be funded. And the bank understands the business's numbers. So the business is saying, oh, not a problem, we're going to sell revenues up 20% next year. The bank looks and goes, nah, not what we want to hear.
Again, feels somewhat counterintuitive, but it's not when you explain it that way. The other thing is you're talking about inflation and the supply chain and inventory. Sometimes there's a lot of viewers who are in the service industry. And we are talking about, again, the cost of recruiting has gone up a lot, right? To find really strong talent. People are making offers that are somewhat crazy. Maybe that's toned down a little bit, but that's really what we saw over the last few years. Mm-hmm. And that is similar. I mean, again, that's their supply chain. Exactly. So that's the cost that they're bearing.
Exactly. So we're seeing service businesses with their direct costs shooting up, and likewise, same story. So the cost of the people you're employing to do the work has gone up, but you're not charging your customers for that work that they're doing more. So the exact same things happen. Your costs have gone up, but the business is not passing them on. So, and you have businesses that have so much work that they can't keep up, and yet they're discounting to get more jobs. And we see it in the construction industry all the time. Construction with so much work that they don't actually know how they can do it because they're short of people, and they're discounting to get another job.
Yeah, seems crazy. Yeah. Again, when you're talking about it, it's just like, that doesn't make any sense. But I know as we talk about it with different companies that it's not so obvious as they're in the midst of doing that.
Exactly.
So, changing subjects a little bit, you talk about, I've heard you talk about all the things you just mentioned, those 7 levers, the code of the business. Can you talk a little bit about what you mean by that?
Yeah. So if we take those 7 levers and we look at the impact that a 1% improvement in for-profit drivers, so 1% price increase compared to a 1% increase in volume, compared to a 1% reduction in overheads, compared to a 1% reduction in direct cost or cost of goods. Those 4 drivers impact on profit. And then what does one day collecting faster, one day paying slower, or one day reduction in inventory, or one day billing one day earlier if we're a service business? So those 7 drivers of cash flow for a profit, what is their impact? So understanding the relationship between those 7 numbers is what we call the code of the business. So we look at business, for example, and say a 1% price increase improves profit by 60,000. A 1% volume increase improves profit by 20,000. So price is 3 times more sensitive than volume. And likewise, we look at that for cash flow. And so in many cases, if price was 3 times more sensitive in profit, it might be 6 or 7 times more sensitive to cash flow. So if we understand those relationships, we understand where the value of the change improvements come from. So I looked at a business 2-3 days ago. The smallest number of the 7 was volume. The second smallest was overheads. What was the business doing to drive improvements? Selling more and trying to manage their costs. There are 5 things they could have done better to improve their cash flow than those 2. So they're working really hard at the things that have the least impact. So that's why we call it the code of the business, understanding what drives the business.
Again, it really goes back then to how do you embed it into the strategy? As someone who, although I worked in an accounting firm, was not a numbers person and still not a numbers person, by using your tool, in fact, the software, it was such an aha for me. And it really just gave you just a simple way of truly doing scenario planning. Well, if we decide to do this, or if this department makes this decision, what's the impact going to be on cash and profit? So it really helped simplify something that I always was afraid of in terms of the numbers, because I didn't really understand them. So
Exactly.
thank you for that.
And then what we do from that is say, well, if we can get this improvement, if we can put prices up 1.5%, collect our receivables 5 days quicker, but we're carrying a bit more inventory, what does that do to our profit and cash flow? And what will that then do to improve the value of the business? So what we do is we look at what the business is worth today, roughly, what the owners want the business to be worth one day, in 5, 2, 6, 10 years when they sell, and what's the gap? And what are we doing towards closing that gap? So we don't expect to hit the value to sell next month or next year, because we don't intend to sell next month or next year. But if we have a business that we want to sell one day for 10 million, and today it's worth 2 million, what are we doing towards making 2 million get to 10 million? Are the things that we're doing driving improvement in profit and cash and ultimately value?
Toward that goal, right? Right. I mean, at the end of the day, people can decide they want to make a different decision, but at least then they understand what the impact's going to be,
Exactly.
whether it's
Exactly.
the longer term value, how long it's going to take to get there, or really, profit in cash at this point.
Exactly.
Yeah.
Yeah. But the point about it is this concept of continuous improvement, and this looking at our Power of One, looking at our code of our business, probably quarterly, ideally, and saying, right, what's the theme for the quarter? What can we do to drive improvement in those three things, profit, cash, value? So what's the theme of this quarter? Is it collecting quicker? Is it billing sooner? Is it, and what can the management team contribute towards improving? And then obviously next quarter, right, did it happen? So theme for the quarter was collections. We had a few things to try and collect faster from our customers. What happened? Did our receivables days reduce? Did the average time we took to collect drop from 65 to 57? Yes, we've succeeded. We're moving towards improving. What's the next thing we can do? And just repeat. And we're seeing businesses have been doing this now for a number of years, and looking at businesses that started with a valuation of 2-3 million that are now sitting at 20 million, and with the team all pulling in the same direction. And as you said, it's strategic.
Well, and the thing I also love about what you're talking about, we're not sitting down with our clients or these companies to say, oh, you need to make these dramatic changes. We're talking about incremental, staying focused on continuing to make those incremental. So you're not really feeling the pain, but it's really moving it forward and staying focused on that longer term goal.
Exactly right. That's why we call it the Power of One, because that's, we come back to price increase. Businesses think 10%. If you put your prices up 10%, your customers will notice.
They will notice.
It can impact.
Right.
But so often you can do 1% or 0.5%. And nobody knows, nobody cares. We've seen businesses put up their prices by 10 cents, 11 cents, 20 cents. No one says anything.
But through the tool, actually, the impact it could have on the business, some people would say, oh, I'm not going to do it for 1% or for 20 cents. It's shocking to see what it does to cash flow and profit.
And the thing is, the business worries, thinks and analyzes so much about what the market's going to think, what the competitors are doing, what the customer are going to say. They focus on all of that, but they don't start by saying this is what it's going to do for our business.
Right. Well, and especially as you said, with inflation, with so much uncertainty, it's so critical to be stepping back and looking at how your decisions are impacting
Yeah. We got an email from someone who said, just want to thank you so much. Your software enabled us to get our sales manager to stop discounting. After 3 years of trying to get him to stop, he finally realized when he saw the impact of discounts.
Because it's black and white. You can't argue it. I mean, that's what I love about it. It's simple, but it really does show the impact of decisions that are being made, that you just don't think a 10-cent difference or a 5% discount is going to really make a difference, but it really does.
We call the code of the company, or the Power One, a disruptor, because it challenges the business to say, oh, wow, you know, we haven't put our prices up for 5 years, and price increase is by far and away the biggest impact, the biggest bang for bucks on our profit and cash. So let's think about it. It challenges our current thinking. It challenges that our customers won't, our market doesn't, our suppliers won't, all these things that businesses kind of say in a dismissive way of not having to think about it. This now makes it right in front, looks and says, right, look at it. It's your biggest number. What are you doing about it?
Yeah, I think the other thing that's really important is, again, this is really not to be a focus of the CFO or the controller. This is really meant for the CEO, the department heads, the people who are really running the business. And that's also different. So that is who this tool, this conversation is really targeted at. Not the finance person, because the finance person is going to go a lot deeper into other things, which is great, and that you need to know. But you know, the other thing is that we tell our clients is, you know, in addition to understanding profit and revenue and margin, making sure that they're getting ideally daily or at least weekly cash flow report. They need to understand what's going in and out from a cash flow perspective.
And on that basis, you know, the definition of cash flow, it's so confusing to so many people, and yet it's so simple, right? Because in the end of the day, if you took all your bank accounts, whether it's money in the bank or whether you owe the bank, if you net them up, you've got a number at the beginning of the year or the beginning of the month or the beginning of the quarter of net cash or debt balances. At the end of the year, quarter, month, whatever, you've got the balances. So if at the beginning of the year, overall you had $100,000 across your various bank accounts, at the end of the year, if you've got $80,000 in your various bank accounts, your cash flow was negative 20. So basically, starting point of debt or cash balances, ending point of debt or cash balances, different net cash flow. So what that number is then tells us on a top level what's happened. So if the business makes a profit of 80,000 but had a negative cash flow of 20,000, where did the money go? That's what we want to understand. Why did we not have a profit that matched our cash flow? The answer is it's usually gone into the balance sheet, either in buying assets, buying a new piece of equipment, a new computer, but usually different to that, it's usually gone into our what we call working capital. It's gone into our receivables, it's gone into our inventory, or it's work we've done that we haven't been able to pay, charge. So what's happening is the balance sheet is effectively stealing from the profit and loss. So we've made a profit, but we don't have the cash. So if we can understand at a simple level why there's a difference, then we can come back to that Power of One and say, well, what are we going to do about it? And
what
so
often control, what can't we control?
Exactly. So, you know, our receivable days, it was last year, the year before last was taking us 45 days on average. Then last year it was 52 days. This year it's 67 days. So it's taking us longer to collect each year. So that money sitting there uncollected, sitting in our customer's bank account instead of ours. If we can understand that, then we can look at our Power of One and say, right, what will happen if we collect 5 days quicker? That's going to bring $70,000 into the business. of money that's ours sitting in our customers' bank accounts.
That's such an important point, because as the economy and some things are changing at this point, people are paying longer. So these are the things that, our viewers should be looking at as red flags and how it's going to impact them. So I think
look at a lot of service businesses. So the person doing the work is usually paid fortnightly or monthly. Some businesses, the work time that they do the work could be a month or two. Then the customer gets billed. So say it's 1.5 months. So person does the work, we pay them fortnightly. A month later, that's billed. Then the customer takes 2 months to pay us. It's 3 months that from the time that we paid that person to do the work to the time that we bank the money. 3 months is crazy.
Working at an accounting firm for such a long time, that was something we were trying to change. So whether it's internal billing or, charging certain flat fees up front and then doing the catch up of any overage later on, because that is a big problem in terms of how long it can take from when you're doing your services to when you're actually collecting.
Exactly. And the point is, you're not going to do something about it if you don't know what it is.
Right.
So if you're measuring it, if you understand it, then you can look at what strategies are we going to put in place to change it. Now, we've seen businesses go from charging, a good example of the business, we looked at their numbers. Their average length of job was 80 days. They were charging 25% up front and the balance on completion, and then 2 months to get paid. So once they looked at their numbers and once they understood that how long that was taking, they changed for new sales, new jobs going forward, 25 up front, 25 after a month, 25 after 2 months, the balance at the end. The new customers didn't matter any difference to them. That brought $300,000 into the business over a period of a year.
Again, I think sometimes we make decisions for our clients and it doesn't make sense for your business.
Exactly.
So good. Well, these are all critical topics, especially with in light of, coming out of COVID and then going through supply chain issues and people issues and all of those things. As we look ahead, any words of wisdom or parting thoughts that advice to give our viewers?
I think it's just the period of where the world is today. Cash flow particularly has never been more important. There's so much uncertainty. What's going on in the world's economy to a lot of extent doesn't make sense because there's labor shortages everywhere. So everyone's saying, where have the people gone?
Yeah. Or how are they living?
Yeah. So if everyone's got jobs, then are we moving into how would we go into a recession and things when everyone's working? So all these uncertainties. And at the end of the day, if we have a good understanding of what drives our business, we can mitigate, we can deal with things before they happen rather than catching up. So if we can get buy-in from our management team to understand what drives our business, we're in a really good shape to be able to deal with whatever comes at us.
And I love your point about if you measure it, then something will get done, right?
If you don't measure it, you can't manage it.
Right.
If you can't manage it, you can't improve it. And we look at the numbers and say, imagine arriving at a sports match, so a football game, and you arrive at halftime and the scoreboard's covered up. So you're watching the game, but you have no idea the context of what's happening. And you can apply that to any sport. Why is that team taking time? Why are they dawdling? Why are they trying to run the clock down? Are they winning? I hope they're winning because they really don't seem that urgent. So we're guessing. if we look at the scoreboard, we know exactly the context of what's happening.
It's such a good analogy. It really is. Well, this was great. So, Josh, what if someone wants to learn more about Cash Flow Story and how it could help them? What would you suggest? Where do they go?
Go to our website, cashflowstory.com, one word, cashflowstory.com. We've got basically for coaches, for accounting firms and other financially literate advisors, coaches being non-financially literate necessarily, businesses themselves. We've got a little bit about, how it works for all of those different markets.
Great. Well, thank you for your time. And again, I think the world of you, your team. I think it's an amazing tool that everyone should have. And this is the stuff that growth is made of. So thank you, viewers, and thank you, Josh, for your time.
And thank you for the opportunity, and keep up the great work.
Thank you.